Welcome to another edition of Around the Table with Stacy Smith as we take a look at economy and investing. There was some encouraging news on the inflation front last week, and the stock markets surged to the upside. Investors believe it may mean the Fed will begin to taper the size of its rate hikes and perhaps bring an end to the rate hikes sooner rather than later. Investors, in fact, were so buoyed by the news that in just 2 days, they sent the NASDAQ higher by 9%, the S&P 500 up by nearly 6.5%, and the Dow up by nearly 4%. In fact, the Dow has now been in a rally mode for some time, and it is now only 8.33% from its all-time high set at the beginning of January, after being down 22%. So how should you be viewing what is happening with the stock markets right now? Well, let's find out. That's one of the topics today as we go around the table with my panel of financial advisors and analysts. At the table, we find Frank Rossetti. Frank has been advising clients for 50 years. Frank helped to establish Harvest Financial, where he is the executive chairman. Across the table, we find Carrie Coghill. Carrie is also the president and CEO of Coghill Investment Strategies, which is headquartered here in Pittsburgh. She is recognized as one of the nation's leading voices on financial advising. Also joining us is a name familiar to a lot of people in Pittsburgh, Bob Fragasso. Bob has been in the investment advisory business for 50 years and is chairman and chief executive officer of Fragasso Financial Advisors. One of my regular panelists, Kim Forrest, could not be with us today. Kim should be back with us again for our next edition in about 2 weeks or so. So I want to thank all of you for joining us. And the last time we talked about the markets edging higher. 2 weeks later, they continue to move to the upside. Having said that, none of the markets, though, have reached the highs that they set back in August. So, Carrie, I know you don't have a crystal ball, but how should we be taking a look at this move up?
Well, I think it's just really important right now to pay attention to the data, because what we have had in the markets is just added volatility. And added volatility happens regardless of direction. We have it on the upside and we have it on the downside. So watching this isn't necessarily the be-all end-all, especially since there's a lot of talk about a possible recession next year. So, what we really have to be looking at, and I know this is something we're going to spend some time on today, is what are those economic data points? And a lot of it right now has to do with, yes, we did get an inflation number out that shows that inflation at least appears to be peaking, really good for the prospects for interest rates, but there's another element, and that's employment. We know the Fed is watching employment, and as we start to hear about some of these layoffs that are coming, the question is really, is the Fed going to be able to achieve what they call a soft landing, where the economy slows, but it doesn't push us into a recession or a deep recession? Or are these effects going to have a much deeper impact on economic activity? That's really the big question right now.
An interesting thing about layoffs, we've had a cost push inflation component because employment costs have risen. With these layoffs, that employment cost factor may be less a factor in the inflation numbers. If that's the case, it will give Chairman Powell and the Fed an opportunity to maybe back off a little bit on the hikes. Not necessarily bring rates down. I'm not sure that is even necessary, but slow down the rise, maybe settle down and not do so much at this point and wait till this shakes out. There's no question that the market is telling us that it thinks that the Fed is not going to raise interest rates as much. But don't forget it, the market said that back in, I think it was July or August. And it was wrong then. It was wrong then. I can't say it's wrong now.
Stacy, I'll come at your question from a different perspective. The explosive growth in the various markets that you referenced illustrates the folly of trying to time markets. If you're out of the market, you can mistakenly zig when you should have zagged. You stay in, you position your portfolio the right way, and you take advantage of what happens. It's a trend line, as Carrie was pointing out, not what happens in the short term. So trying to time markets, you could have missed that very significant upturn in value that you described.
Yeah, and I'll just add to that. When we're looking at markets, and as Bob said, you can't time these markets. It's not about that. I think that the value of this information that we get, and trying to do some economic forecasting and really understand the dynamics of where we are in the business cycle, is helpful for investors in terms of timing of doing things like rebalancing their portfolio, or what should I do if I have money to invest from cash, where should I put it? Or if I have to take distributions in my cash flow, where should I take it from? So, understanding what sectors of the market do better or worse, given where we are in the economic cycle, is really valuable to investors. And that's why we go through this process of trying to discern what the Fed is going to do and where the economy is going.
Do any of you look at charts?
I do.
Okay. What have you found, Frank, is a better chart to look at? A daily, a weekly, a monthly, or does it matter?
I look at levels, not so much the tick by tick thing. All right. I see that twice now we've challenged this 3,500, 3,600 level on the Standard and Poor. We now are bumping up on 4,000 again. And today, yes, Friday and again today, the market's kind of struggling with that level. That's telling me that we're still maybe range bound, and the opportunity to, as Carrie says, add new money may be better done after it pulls back from here. Then again, if it breaks through, I wouldn't hesitate, because as Bob says, now you're trying to time, and if it breaks through support or resistance levels, the odds are that that's usually a good sign or a bad sign, depending on which one you're looking at.
So if it were to break through the S&P 500, that you might consider taking some cash off the table and putting it back into the market.
I've been taking cash off the table for most of the year as we hit levels. I mean, to try to time it is folly, as Bob says. But when you have capital available, it makes sense to pay attention to how the market's moving, and maybe delay purchasing or selling, but depending on what your goals are, short and long. As we've all said time and time again, our clients that are living off their income, we have that money out of the market 2-3 years in advance. And the day-to-day trading has very little to do with their ability to pay their utility bills.
I was in a professional service office the other day, and the young woman at the desk said that offered that she was no longer contributing to her 401k plan, the employer plan, because it had gone down, and she was going to wait until it recovered to come back. You see the point? You say, no, who would do that? But people become emotionally involved, and when you start that, then you start to say, I'm going to get out, I'm going to get in, I'm not too expensive. And I said, you don't want to buy it when it's on sale. You want to wait until you can pay full price. Think about that. You keep buying as the money's available, but you put it into the right things. And that's what I think all three of us have said all along. You allocate and then you choose, and that's where your money goes. And over time, it'll work fine.
We're going to talk also about where some people are trying to put their money when we come back, as we take a break here on Around the Table with Stacy Smith.